Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering a question I ran across on one of the Facebook investor groups that I'm joined in, and I thought it would be a good, interesting topic for one of the videos. So the user said, I'm sorry, but why do most dividend investors only maintain a yield of 3 to 5% where I see tons of dividend stocks out there with yields over 5 to 10%? I understand volatility and the risk plays a role, but is there a bigger picture that I am missing and that everyone chooses these low yields for? So I'm going to go ahead and use some of this room here to kind of showcase two stocks. So I'm going to go ahead and pick Johnson & Johnson because I know this one is a relatively, maybe not a 3 to 5% yield, maybe Procter & Gamble, Johnson & Johnson. We'll see which one of the two has a yield somewhere around 3 to 5%. And then our second stock we're going to be taking a look at, I went over to dividend.com, selected high yield stocks, and I'm going to go ahead and just select one of these here. You can see the dividend yields are here, are in the very high teens here. So I'm going to go ahead and select the Chesapeake Granite Wash. So we'll go ahead and open up this one here, and we'll go ahead and type in the ticker symbol, which is CHKR. Now our Procter & Gamble, let's go ahead and pull this one up as well. So let's see, Procter & Gamble, this has a 3.0, so that works perfectly. Okay, so for example, we're going to be using Procter & Gamble and CHKR. Now, the Procter & Gamble right now has a dividend yield of 3.02. It's currently priced at $90.65. Now, let's say this one has 3% yield, and let's see, let's just go over the last few years. So this is actually going to take, what do we want to showcase here? We want to showcase, basically, let's go ahead and just look at the dividend, and we'll say that over the max time that this dividend has been able to get paid out, and we'll see the dividend yield during this time frame. So we'll see here that the dividend yield is currently sitting at 3.02, whereas in the past, in 2000s, with the stock, what do I have right now? The dividend yield, we can see the price. Okay, so here we have the price of the stock in comparison to the dividend payout, and we can see that the dividend payout is a very consistent payout since about 1985. So it's been paying out a dividend roughly 32 years. Now, if we switch over to Chesapeake Granite, we can see that over the last few years they decided to pay out a dividend beginning back in 2012, but this has been a steady decline. They started off at roughly, let's go and take a look at the yield here. They've had a probably consistent right around 19-15% yield, so it stays up there in the area. And these can be kind of risky. You can see here, this is just the dividend payout that they've paid out over the last 5 years. So this is all we're going to be taking a look at as this 5-year data. Now, there's some volatility here, especially if you bought into the stock at, say, a high peak and it has fallen down. Then your capital gains would have depreciated with this. The stock has been on a constant fall since it was it came out as an IPO, and it IPO'd maybe at $17.50. It's now sitting at $1.85. That makes this yield very high. Now, the dividend history for it, they started off paying roughly 65 cents per share, and they're now paying out only 6 cents per share. Now, we're only going to be covering the dividend, the price, and the dividend yield. Now, if we look over at Procter & Gamble and we look at their dividend over the same time frame, they've been very consistently going up. Their price has very consistently going up. They do have some corrections here, but those are great buying opportunities that you can, average down on, add to your portfolio, your equity, and then it continues on its upwards trend. Now, if you had invested so this one became public back in 2012. So we'll say 2012 here is our starting point. And we'll say that what's Chesapeake's dividend yield? It is 19.34% yield. And we're only going to use the time frame of 2012. And we'll say that we had $1,000, or let's say $10,000 to begin our investment journey. Now, over this time frame, if you had put $10,000 into Chesapeake in 2012, let's go ahead and do some quick math here. We'll say $10,000 divided by the buyout price, or starting price, is right around $18, we'll say. That buys us 555 shares. Now this is probably a terrible way to diversify, but this is all just an example. Again, $10,000 going into Procter & Gamble. Back at 5 years, we'll say that the price was roughly 70. It's much lower than $70, but we're going to say, well, actually it's about $70. So we'll say $10,000 by $70. That gives us 142 shares. Now, during this time frame, Procter & Gamble, over those 12 years, increased and now sitting at $90.65. So 90, we still have the 70 original shares, but this is going to be really hard to calculate because if we had DRIP, if we were able to reinvest those dividends that they paid out, it would actually be quite a bit more. So let's see, we have 142 shares. So we take those 142 shares, we multiply it by its currently priced at $90. We'll say $90, and that gives us the current value capital appreciation. 142 times 90 is 12,780. 12,780. But this is all just from capital appreciation over the last few years, say 5 years. Same thing with this one. If we take a look at our 550 shares and we multiplied it by what it's worth now, it is $1.85. So we roughly have $1,000 left of our capital appreciation. It is $1.85. So we'll say that's a little over 1,000, right? 1026. So you lost quite a bit of equity there. Now the yield, though, that would have been nice, right? So we can see that the dividend here for Granite and Peak, it declined very quickly in 2015, 2016. So we'll take the average here of say 0.65. They paid out for a year. So we'll say .65 times 4, and then they had another year of around 0.55 times 4. They had another year of around 0.35 times 4. And they had another year of around, it looks like it dropped down all the way down from this point here of around 0.25. So 1, 2, 3, 1, 2, 3. And then they dropped it mid-year all the way down to, say, 6 cents. So we'll put 0.06, and then we'll say another 0.06. And we'll take the average of these. So 0.65 plus 0.55, 0.35 plus 0.06 plus 0.06 times 4, and that gets us $6.68. Oh, 6 cents and 60. Boy, my math is terrible. Hold on, let me pause the video. Forgot to divide by however many I had. So 0.65 plus 0.55 plus 0.35 plus 0.06 plus 0.06 divided by the number that we had in there, which is 5 of them. 1, 2, 3, 4, 5 is 0.33. So 0.33 will be our average payout price for those years. So we'll take the shares of 555, multiply it by 0.33, and during that time we could have expected to have earned roughly $183.15 in dividends. That's just a very rough estimate. This is not exactly what you would get. Now, kind of doing the same math as I did terribly here with Procter & Gamble over those same 5 years, let's go ahead and do that right here. So let's take the average of these over the last couple 5 years. So 0.56, we have the next year we have around 0.6. The next year we have around 0.64. The next year we have around 0.66. And the next year we have around 0.69. So again, we do the quick math on there. 0.56 plus 0.6 plus 0.64 plus 0.66 plus 0.69 divided by 5 gets us 0.63 as around our average to use, and we multiply this by however many shares we held during that time frame, and that would roughly get us 142 times 0.63. We would have earned roughly $89 per year. Okay, so this is per year. So let's go ahead, and that's per year. So 89.46 times 5 is $447 during that 5-year period, just off dividends. And we'll go down here and do the same to this one, and that would have been slightly higher at 915.75. So there we go. Just doing some very, very rough math. Procter & Gamble has a very low yield, but they have a consistent yield of increasing their dividends. You know, they're sitting at currently 3% at their current price, and once we did all the math here, I don't know where the heck I got 89.46. 447 divided by 5 is 89.46. Oh, I multiplied it, right? Is that how I did it? Okay, that's the average, and this is how many shares we got. So this is the total per year. This is total per year, and times it by 5 years is 447 over 5-year period if we had not reinvested those dividends. And this is 555 shares by the average of 0.33. Multiply that, this is per year, and this is over a 5-year period. But we take this, so now we have our capital appreciation plus the 447 that we earned from those dividends, and that would have got us, just doing the quick math on there, 13,100 and let's say 220. And down here we would have got our 1,026 plus 915 is say 930, 1944, 1. So we would be left with $1,941 if we had invested in CHKR and had left it in over those 5 years. But if we had taken that same amount of capital and invested in Procter & Gamble, which has a little bit of lower yield, but it's a much more stable company. It's a blue chip company. It has a history of increasing their dividends year after year. They don't pull back their dividends during these crashes or events here. Let's go back over here. You know, they're really consistent over this time frame. So that's what you want to invest for. You know, you want to invest for not just now, but you want to invest in the future. So imagine if you had bought Procter & Gamble back in 1990 and they had increased their dividend. So eventually, if they increased their dividend by say 7% every single year, over 10 years, you would basically double your dividend payout, because the rule of 72, you take 72 divided by the yield, and that would, you know, it's a fun little thing there. But video was a bit, maybe it may have been confusing. I could definitely break it down. I just thought this would be kind of a fun video very quickly with terrible math thrown in here. So I will probably redo this video if you guys would like. And that was kind of just answering a question over at a Facebook group. So That is it for this video. If you did enjoy the video, hit the like button below. Remember to subscribe to my channel for future financial videos. This is why you invest for the long term. You don't just look at yields that have a 10-15% yield and buy it, because you're not buying it. You could be buying it for the income right now, but what if that stock tanks? I'd rather invest in a blue chip company that I know will continuously gain capital appreciation, will continuously gain and continue to pay out dividend and have dividend growth. So that is it for this video. If you thought it was insightful, go ahead and hit the like button. If you're a recurring viewer, hit the subscribe button, and I will see you guys next time. Bye bye.